Let's get more on the markets. We're joined by Michael Green, Chief Investment Strategist at Simplify Asset Management. Michael, always great to see you. Thank you very much indeed for joining us.
Oh, it's always a lot of fun to be here. Thank you for having me.
Before we explore larger themes, the narrative over I hate that expression, I'm sorry. The worry in the markets over the past few days seems to be we might not get many interest rate cuts at all this year. Do you think that's what's been weighing on stocks, just diminished expectations for rate cuts?
Well, I certainly think that hasn't helped. And so one of the components that we're struggling with is what is the actual information that's causing people to doubt the rate cuts. Mm-hmm. Things like the non-farm payrolls coming in very strong on Friday. This is something that I've highlighted with you repeatedly. The birth-death model was a huge contributor to that number. This is the adjustments that they attempt to make within the United States for new businesses that are being formed. Unfortunately, at this point, we just know that number is terribly wrong. It's kind of the easiest way to put it. And as a result, the data that we're getting is very uncertain in that framework. In particular, we saw the ADP being relatively weak, and ADP importantly highlighted that almost no growth is happening in small businesses. That birth-death number coming from the Bureau of Labor Statistics suggests that all the job growth is coming from small businesses. We know why this is happening. We know that data is going to be revised. And so I very much think the opportunity set is being set, or the opportunity is being created for people to bet on the Fed being more aggressive as we come through this year versus the opposite.
So remind us on your view of inflation. Are we being alarmist about inflation? I mean, is it weaker, lower than the pessimists fear?
I think it is, and I want to put some notable caveats on that. So every individual is going to experience their own inflationary components. Mm-hmm. When we look at things like mortgage insurance or auto insurance, those are very lagging components. If the cost of cars goes up last year, the cost of replacing those cars goes up, the insurance companies are going to charge me more this year. So those types of lagging components are carrying through. This is why it's so important that Jerome Powell highlighted in December, at the December speech, that he was shifting his emphasis to market-based as compared to imputed prices. This is something that's never been talked about by the Fed before. Waller did the exact same statement just last week, highlighting the difference between imputed prices, which would include things like owner's equivalent rent, and market prices, which are much more timely and directly measured components. That suggests to me that the Fed is increasingly worried about the prospect of deflation, not inflation. And that's further exacerbated by the seasonality adjustments that kick in inflation. I wrote quite a bit about this last summer, that what we experienced during the summer was a very positive inflation seasonality component. If you remember, in the summer of 2022, Russia invaded Ukraine. We ended up with very high oil prices. As we've anniversaried those types of experiences, and then obviously the pandemic reopening as well, as we anniversary those, we're moving back towards normal seasonality, but the seasonality adjustments are corrupted by the impact of the pandemic and the invasion of Ukraine. As those anniversary, we're likely to see a similar phenomenon where inflation comes in weak this summer. That is almost certainly going to put the Fed back into the mode of cutting significantly more times in 2025.
Oh, you think we are going to get a substantial number of rate cuts this year?
I think there's a very real chance of that. There's an awful lot of enthusiasm right now for the fact that we have avoided the recession, that the yield curve is normalized. It's when the yield curve normalizes that you really got to be watching out for the recession. I think what has surprised people is how little impact it had in terms of the Fed rate hikes. We've discussed a lot of the bifurcation components. The simple answer is very little in the form of financing occurs at the short end of the curve. There's very little floating rate debt out there relative to floating rate assets, which would include everything from money market funds to certificates of deposits on down. There's about $12.5 trillion worth of assets that was positively affected by the Fed's rate hikes. There's only about $7 trillion worth of debt that was negatively affected, and the companies have basically been engaged in extend and pretend, or simply pretend. Let's pretend we don't have to refinance this debt at higher coupons. As that duration continues to expire, we're seeing more and more companies face the prospect of having to refinance at much higher rates, and that's leading to elevated levels of bankruptcy, which is really the question that I think we all should be struggling with. Why doesn't the market recognize this?
Recognize, for example, the pressure that's going to be on highly indebted corporations?
Correct. Yes, exactly that.
One thing we hear, and I'm sorry, I'm kind of switching topics here. We hear there's a vast amount of money on the sidelines in money market funds, and it's given as a reason for buying equities. What would you think of that?
Well, I mean, I guess I could make the exact same argument for bonds, right? There's a vast amount of money in short-dated income instruments. Why wouldn't people use that to buy longer-dated bonds? And now that those bonds are trading at a premium, the simple reality is very little of that money ever leaves cash balance sheets for the very obvious reason that if I convert my cash into shares, somebody else had to convert their shares into cash. So that money on the sidelines doesn't really change very much. More importantly, if we look at that money as a fraction of stock market value in total, so the percentage of cash, it's actually very low. So I'm not a big fan of the money on the sidelines type argument.
Could we maybe, now this might be going over ground that you've already touched on, but maybe we can have a look at that old 10-year bond yield again. And we've seen the 30-year bond yield threatening to get up to 5%. But when you see the 5-year bond yield moving up towards, the 10-year bond yield moving up towards 5%, if we get to 5%, will that be some kind of a psychological breaking point for the market? Will people really get worried?
Well, I think it's less of a psychological breaking point, right? It's not like I run screaming from my house if interest rates go 5% versus 5.01%. But what it is a psychological level, and importantly, the relationship between bonds and equities in institutional portfolios is often very nonlinear. Imagine that you're an institution and you have an obligation. Your requirement is that you hit 7% targeted return. If interest rates go from 1% to 2%, I don't really change the composition of my portfolio very much because that 2% doesn't get me very far towards my goal. But if interest rates are at 5% or 6% or 7%, then all of a sudden the question enters, why are we even in equities at all? Why would we take any risk whatsoever? And I am starting to hear those conversations happen on the institutional side. And I would agree that 5% does feel like one of those levels. Mm-hmm. The next part of that question becomes, which game do you want to play? Do you want to play the proverbial, I know you know what I think you know sort of game, in which it becomes, well, if everybody else is going to switch at 5%, maybe I should switch at 4.9%. And if everybody else is going to switch at 4.9%, maybe I should switch at 4.8. So like that level, I think, is ultimately less important than the indication of it, which is a lot of people can increasingly meet their retirement objectives and spending objectives without involving equities whatsoever. And so we should be watching for that type of switch.
That's interesting. It's interesting, though. I know what you know, and I know the gamblers call it leveling, apparently. Yeah, and it can go on into turn into a black hole, I guess, ultimately. Michael, we could talk to you all day. Thank you very much indeed.